Welcome to Fall into ETF Investing, a special edition of ETF Market Insights. I'm Erin Allen, Vice President of Online Distribution at BMO ETFs, and in just a moment, I'm going to be turning over my hosting duties to Kornel Szrejber. But before I do, a quick reminder that today's episode, we're not providing you any advice or investment recommendations. Today's show is all about providing education around the markets and around investing in ETFs for Canadian do-it-yourself investors. Kornel is the host of the Build Wealth Canada podcast, where he talks a lot about investing and personal finance topics. He's also the founder of the Canadian Financial Summit, which is an online virtual.
Today, we're going to talk about how to build a strong core using broad market ETFs. And we're going to be covering some best practices when it comes to deciding which index to actually use and which ETFs to use within your portfolio. And to help me with this, I have Alfred Lee from BMO ETFs. He is a portfolio manager, a director, and an investment strategist. And we have Graham Mackenzie, who is the managing director of exchange-traded funds over at TMX. And so guys, welcome. And let's kick things off with the first question. When it comes to broad market index ETFs, what are really the main benefits of those?
Well, why don't I jump in there? One of the really great benefits of broad market index products or ETFs is that they really deliver the building blocks of trying to build the core of someone's portfolio. And then you can build from there. And what's great about them is they naturally provide diversification because they're broad, obviously, and they essentially encompass the entire market with one product. With that, therefore, you get low costs because of not only economies of scale, but they're easier. I don't want to say they're easier to manage necessarily, but they require particularly less cost than, say, an actively managed fund. So you get the benefit of diversification, you get the benefit of costs. And that really, from there, you're able to start to build your portfolio.
Awesome. Did you have anything to add, Alfred, or do you think that covers it pretty well?
I think he covered a lot of it. I think ETFs represent a lot of efficiencies in the market. So as Graham mentioned, covering the entire market, but also their ease of access and low management fees as well, which is what really made ETFs really popular over the last 10 to 15 years. Mm-hmm.
Now, yeah, we've seen a lot of growth in these core ETFs, especially over the pandemic. Why do you guys think that is?
Well, I think due to a number of different factors. I think, time, for example, if you recall during the lockdowns, we had a lot of time on our hands. I think a lot of people took on a lot of interest, whether it was baking or fitness, but I think investing was one of them, right? So we all heard about the Reddit army, or just a lot of the growth in the do-it-yourself investor. So I think a lot of people had a lot of time on their hands, but in addition to that, a lot more disposable income as well, right? So when I think back during the pandemic, I wasn't really spending on much. I was spending on, the occasional trip to the grocery store, maybe on a few Amazon purchases, but a lot of people had disposable income. So whether it was, that lack of spending, but also due to the emergency response benefits, a lot of people had more disposable income. So I thought they were allocating it to the market. In addition to that, I think the market really bounced back really quickly when the government put stimulus, the central bank put a lot of monetary stimulus as well. So the market bounced back, and a lot of people took notice. There was that fear of missing out. And when it came to ETFs, as Graham mentioned, all the benefits of ETFs, a lot of people saw those efficiencies. But even when it came to a lot of the seasoned investors, I thought, they identified that during March and April of 2020, when liquidity dried up, a lot of their traditional investment vehicles didn't have that liquidity. So whereas the ETF continued to trade, they really were attracted to the benefits of ETFs in general. But what we find is during major market sell-offs in the last 10 to 15 years, 2008 being a good example, 2020 being another good example as well, as Graham could probably attest to, during market sell-offs, there's an increase in volume and there's an increase in assets going into ETFs just because of those efficiencies that we've talked about.
Gotcha. Anything to add on your end, Graham?
No, I think Alfred really summed it up well. I think there was an excess amount of capital and money available at the time, and I think there's been a lot of conversation, both from in the media and the press, as well as from a regulatory perspective, about costs of making investments. And I think that resonated with a lot of people, and ETFs essentially were our vehicle that people were able to save investment dollars and put them to work through an ETF vehicle. So I think that in itself also is why people chose ETFs over other investment vehicles.
And I think another point is that for an ETF, during those market sell-offs, people don't necessarily want to pick individual stocks. What they know is, they want exposure to the market, and this is the best way of getting it through an ETF, cost-efficient, liquid. So it's not necessarily about stock picking, but it's just that the market is undervalued at this point. What's the most efficient way of getting into the market?
Mm-hmm. Gotcha. And broad market ETFs, obviously they track an index. And I think a lot of the viewers today are probably familiar with a lot of the main index providers like the S&P, the FTSE, the MSCI. How is that relevant? Why is it important which index is actually being tracked within these core ETFs?
Well, I think it's important to recognize that the index that an ETF tracks really does matter in a sense that you want to be comfortable and assured that the ETF that you buy is actually replicating or tracking what you're expecting it to. And so therefore you really need to pay attention to that, because two ETFs that are tracking, a similar market but have two different indices following will potentially have two different outcomes. So it's important to understand the methodology and the parameters that are put behind an index while choosing a product. Mm-hmm. And while that sounds challenging, it is fairly laid out there, and a lot of the larger index providers do provide information, and you'll find that on websites and everywhere where you get some sense of, okay, this is actually going to do what it does. And an index provider, what they can provide and help is the experience that they have, in the sense that if they're, before they come to market, they've been back tested or they have the experience of knowing it, then they know how to manage corporate events, because everything from M&A activity that a company does, dividends, buybacks, all these corporate activities that happen translate into the index weightings. And if they can't manage that in an efficient manner, or it's challenging for the ETF provider to replicate or follow, then tracking error happens. So there is a lot of advantages to who the index provider could be or is.
Mm-hmm. I think in addition to that, I think reputation is definitely very important in terms of the index provider. But on top of that, I think to a retail investor or a do-it-yourself investor, it doesn't really matter which index we track on the surface, right? As long as it provides exposure to that asset class. The benefit, however, is that when you track these name brand indexes, a lot of institutions are benchmarked to these indexes, right? So because it attracts institutional users in a various degree or a broader a different amount of investors, it does enhance the liquidity of that ETF. So because we attract institutional investors on certain indexes, family office or whatever it may be, there's more people using that ETF, and it does enhance the liquidity of that ETF.
Mm-hmm. Gotcha. And now you're from BMO, and BMO has a whole suite of these broad market ETFs. Can you talk about some of them?
Sure. So we do have a number of core ETFs. So before I get into that, why don't I just talk about what those cores are?
Sure.
So the core ETFs are basically what I view as the major building blocks in your portfolio. So those would be Canadian equities, U.S. equities, international equities, emerging market equities, and also Canadian bonds as well. So I think when you're putting together a portfolio, these are the necessary building blocks when it comes to constructing a portfolio. I think when you look at how portfolios are built now compared to even 10 years ago, people looked at diversification and it was 20 to 30 stocks, and that was properly diversified. But I think what a lot of people realized is that during, especially market sell-offs, these stocks could be really correlated, right? So a lot of investors are now focusing more so on, not just diversification within an asset class, but also diversification across asset classes as well. So, ETFs provide that. They provide, total exposure to a market, as Graham mentioned, but they also provide exposure to those building blocks, right? So there's an ETF that track all those necessarily building blocks that I mentioned in all those core asset classes. And through that, investors can properly construct, well-diversified portfolio.
Gotcha. And how does the broad market ETF approach compare to some of the other investing approaches that we see?
That's a good question. I think, if you compare to active management, for example, I think active management gets a lot of attention just in terms of a lot of investors are always concerned about, what stocks am I buying? When should I buy these stocks? So security selection and market timing, I find, gets a lot of attention. But when you look at historically how passive investments have performed versus active investment vehicles or active managers, very few active managers have outperformed the index over the long haul. So take US large cap equity managers as an example. Very few of them have outperformed the S&P 500 over time. So the S&P, so the Standard & Poor's, they put together a monthly report called the SPIVA report, which stands for the S&P index versus active. So it's a very interesting report. So I took a look at the most recent report this morning, and 90% of active managers underperformed the S&P 500 when it came to large cap US equities. But that's not atypical of this month. That's pretty consistent across all time frames. And it's also pretty consistent across different asset classes as well, whether it's mid cap, small caps, even bonds and other jurisdictions as well when it comes to Canadian equities. So again, I think a lot of fanfare goes into active management, but the proper way of constructing a portfolio from my point of view is focusing on those building blocks as I mentioned and using ETFs to get those passive exposures.
Graham, any thoughts?
No, I think it's important when someone's trying to build their portfolio and looking at building their core. I think it's a really relevant point that comes out of the SPIVA reports. There's no doubt that if you're looking for market returns, there's other potential ways that you can essentially add alpha to your portfolio or enhance it instead of when you're dealing with core, you really got to look at market returns and get that exposure and that diversity and that take advantage of the cost advantage.
Gotcha. When you're doing the broad market index investing, what are some of the key considerations that you think investors should factor in when they're deciding and constructing their portfolio?
Well, I think some of the things that people need to be thinking about is obviously their weightings. Alfred had sort of mentioned some of the core areas that are used to build the foundation of one's portfolio, but there's also home bias. Canadians tend to be more invested in North American securities just because that's what we know, whereas there's a whole world in further diversification that's available from that perspective in time horizon, risk tolerances. Alfred, elaborate on that? Or
Yeah, I think those are all good points. I think home bias is one that really matters a lot to Canadian investors. So when you look at the Canadian market, it's really made up of three sectors: finance, energy, and material. Sometimes it makes up over 70% of the market. That's just the nature of our economy. So when you look at these sectors, they are highly cyclical, meaning that when the economy is performing well, these sectors tend to perform well. But when the economy contracts, there's not a whole lot of defensive exposure of the Canadian equity market, right? So going beyond Canada, I think, allows investors to get diversification, not just from a country level, but just also from a sector level as well. But I think another consideration that investors have to think about is when they go outside of Canada, there's also the currency exposure as well, right? So, when you invest in Canada, the only thing they have to worry about is the performance of the underlying securities. But when they go outside of Canada, they also have to consider, the impact of the currency versus the Canadian dollar as well. The good thing to Canadian investors is that through the innovation of the ETF market, there's also currency hedged ETFs as well. So these currency hedged ETFs, I think, are great tools for investors because not only does it allow investors to have exposure to the broad market index, but it also allows investors to hedge out that potential currency risk as well.
Gotcha. What about investors who want to allocate some money outside of broad market ETFs? So maybe there are certain sectors or themes that they want to tilt towards, maybe clean energy, robotics, for example. How can someone have both a part of their portfolio in broad market total index funds and another part that's also sort of satellite approaches?
Well, I think, the fact that we've been talking about these broad market ETFs and really what they are, and we've defined them as, and what they're defined generally as, is core, and that's essentially what purpose they're solving. Then you can add on to that in manners in which to either further add diversification, create non-correlated returns with other asset classes, or essentially look at some of the sectors or themes that you just mentioned as ways to enhance performance. And so really what that tends to be referred to is sort of a core satellite approach to one's portfolio. So you build the core, that foundation of that portfolio, and then on the outside of that, you start to build satellites that represent all kinds of different either themes, sectors, asset classes, and manners in which you can reduce risk and look to essentially enhance the performance of the portfolio. And maybe this is where, for some, this would be where they would potentially add an active mandate to the portfolio that Alfred was pointing out earlier, that perhaps doesn't necessarily always fit in building someone's core of their portfolio.
Gotcha. Did you have anything to add to that one, Alfred?
Yeah, I think, core satellite, I think that is, when you look at it, it's a very structured way of, outperforming the market. So, if you allocate, let's say, 70 or 80% or whatever you choose to an index, and then the remaining percentage to, a thematic ETF or a sector-based ETF, or even individual stocks, that it's a more structured way of taking a small part of your portfolio and risking that in order to potentially outperform the market. So we see a lot of institutions that actually do that. So it's a very effective strategy, and I think it's a very, solid way of building a portfolio.
Gotcha. How can an investor who is new to all this and would like to build a portfolio of core ETFs, how can they do that when they don't even really know how to build a portfolio yet?
Yeah, it's a great question. I think, when you look at asset allocation, what a lot of investors may not know is asset allocation is actually the most critical decision that investors have to make. So academic studies have actually shown that asset allocation determines, the major determinant of risk and return in your portfolio. When it comes to market timing and security selection, it actually means very little compared to asset allocation. So the bigger question is, how do you do that on your own? The good thing is that, in the ETF world, there are kind of pre-made asset allocation ETFs for investors. So we have a number of asset allocation ETFs, for example, that are based on various risk profiles, all the way from conservative all the way up to an all equity portfolio. So the beauty of these ETFs is that it's made up of 6 to 9 different ETFs. So it gets you exposure to not just Canadian equities, international equities, but also bonds as well. But the good thing is that they're professionally managed as well, and rebalanced on a regular basis. But the other good thing is that the management fee of 20 basis points, that's the only fee you pay. So you don't pay the fee on the underlying ETFs in addition to that. So it's a very effective way of building a portfolio. There's a couple of ways of using them. So, you could hold that in your portfolio as the only holding. But in addition to that, you could also, as Graham mentioned, you could use that in a core satellite strategy where you combine, one of these asset allocation ETFs, and then you sprinkle in, whether it's single securities, an active mutual fund, or either, sector or thematic based ETFs on top of that as well. So very practical solutions, especially for a lot of investors that are new to investing and don't have the time or resources or the know-how of putting together a proper portfolio.
Gotcha. Well, guys, thank you so much for your expertise. It's really, I think, great information, especially for investors who are new to all of this and they want to figure out, okay, how can we actually implement some of this? What are some of the key considerations when we're trying to build a portfolio? So really a big thanks to you guys for coming on, sharing your expertise. And a big thanks to BMO ETFs as well for putting on these free sessions for DIY investors. They're a huge help. And again, guys, thank you so much for coming. Thank you to BMO ETFs. And we hope to see you next time. Take care.